If you're buying into the common crypto narrative for 2026, you could be making an incredibly expensive mistake. There's a surprising twist in 2025's market that almost everybody missed, and it completely changes the rules of the game.
Okay, let's just dive right in, because this says it all. While everyone was talking about crypto, the reality was, well, pretty shocking. Bitcoin ended 2025 completely flat. Now look at that compared to commodities. Silver just exploded, up 70%, and gold surged 50%. Yeah, in a year that was supposed to be all about crypto, Bitcoin was literally the worst performing major asset.
Look, that kind of underperformance isn't just a number on a chart. It's a massive, flashing red flag. Stick with me, because by the end of this explainer, you're going to know the real signals you need to be watching to protect your portfolio from what macro expert Jim Bianco is calling the 2026 liquidity trap.
To really understand the trap that's being set, we first have to pull back the curtain on just how deceptive the 2025 crypto market really was.
The year kicked off with this super powerful story, right? Institutional adoption, ETFs, big companies buying Bitcoin for their treasuries, all that stuff. And it drove a ton of hype through the first half of the year. But the peak? It wasn't driven by fundamentals at all. Nope. It was a classic sell the news event in July, right after the Genius Act, a big piece of crypto regulation, got signed. And the result of all that excitement? It just fizzled out, and the market ended the year right back where it started, flat.
So let's peel back the layers on this whole institutional adoption story. I mean, the headlines we're seeing right now sound incredibly bullish, but they're hiding a pretty dangerous reality.
Okay, so in December of 2025, we got two announcements that seemed like bombshells. First, Vanguard, a company that's been skeptical of crypto for years, finally gave in and opened its platform to spot crypto ETFs. Then, Bank of America said it's going to let its advisors recommend a 1 to 4% crypto allocation to clients. I mean, on the surface, that sounds like the floodgates are about to burst open, right?
So this is where you have two very different stories. The popular narrative, the one you hear everywhere, is promising this absolute tidal wave of institutional cash. But the reality, according to experts like Jim Bianco, is a lot more grounded. They're asking the really critical question: which wealth manager in their right mind is going to risk their career telling clients to buy an asset that just got totally crushed by gold and silver?
And Bianco just says it perfectly here. This really gets to the core of it. He says, wealth managers are unlikely to rush clients into a falling knife asset class that just underperformed everything else in 2025. It's just from a pure marketing standpoint, the timing for all this new institutional access couldn't be worse.
And that leads us straight into the next major risk factor, something that makes this whole market threat feel very, very real. What I'm calling MicroStrategy's ticking leverage bomb.
Remember this number, $74,000. You could argue this is the single most important price level in the entire crypto market right now. So what's so special about 74K? Well, it's MicroStrategy's average cost basis for their huge pile of Bitcoin. And it's become more than just a number. It's like this psychological line in the sand. For all those other institutions that followed them into crypto, watching Bitcoin dip below that level would be a massive blow to their confidence.
And here's the crucial part of Bianco's prediction. He thinks the market will probably have to push Bitcoin below that $74,000 mark. Now, the goal wouldn't be to just crash it. The goal would be to flush out all the leverage players. You know, the other treasury companies that just copied the MicroStrategy playbook. It's a painful process, for sure, but maybe a necessary one before any real sustained recovery can start.
Okay, so all of this is setting the stage for the absolute core of Bianco's warning, the 2026 macro liquidity trap. This is where we see why this cycle is just fundamentally different from anything we've ever seen before.
So first off, what even is a liquidity trap? Well, simply put, it's when central banks, like the Federal Reserve, basically lose their superpowers. They can print trillions of dollars, but if inflation is already running hot, that money doesn't really do anything to boost the economy or pump up asset prices. It just gets stuck. Or even worse, it makes inflation even more painful for everybody.
And this slide right here, this is the entire thesis in one simple picture. The playbook we all got used to from, say, 2010 to 2022 was super simple. Economy gets weak, inflation is low, so the Fed prints money, that's quantitative easing or QE, and boom, all assets go to the moon. But the reality of the 2020s is totally different. Core inflation is still sticky. It's stuck above 3%.
So now, if the Fed tries to pump in more money, you don't get an asset boom, you risk firing up inflation all over again, which would crash the economy and totally spook risk markets like crypto. The Fed is in a trap.
You know, if you're getting value from this kind of deep dive analysis, do us a favor here at Crypto Global News. Make sure to like, share, and subscribe. Oh, and definitely hit that bell icon. That's the best way to make sure you don't miss these critical updates when the market starts to shift.
Now, a quick but really important detour. You're probably thinking, okay, but what about gold's massive rally? Well, it's not the simple de-dollarization story you might hear. Bianco's analysis shows it's being driven overwhelmingly by the People's Bank of China and by Chinese citizens themselves. They're basically hedging pretty desperately against their own slowing economy, looking for a safe place to put their money. It's a very specific signal about China, not a global one.
So, with the old playbook totally broken, what should you actually be paying attention to? Let's break down a really clear path forward.
All right, forget the daily noise and the hype. Here are the 3 signals that actually matter. Number 1, watch Bitcoin's price like a hawk around that $74,000 MicroStrategy level. If it breaks below, that could be the signal that the big leverage flush is happening. 2, keep a close eye on core inflation data. If it stays stubbornly above 3%, the Fed's hands are tied and that liquidity trap is in full effect. And 3, watch the gold buying coming out of China. It's become a key indicator of geopolitical stress.
And all of this brings us to the final, critical question. The old playbook, the one where any bad news meant the Fed would just come in and print more money to save the day, that playbook is officially broken. The rules of the game have fundamentally changed, and the only question left to ask is your portfolio ready for it?
Stay ahead in the crypto market. Subscribe now for the latest global news and updates.